What's the difference between mutual funds, index funds, and ETFs? Each of them are similar in some ways, different in others, but if you learn the difference between the three, it's going to save you a lot of hassle and a bunch of money. We hear these terms get thrown around a lot, interchangeably, and it can be very confusing. It's extremely imperative that if you don't truly understand the difference between the three, that you learn it today. When I first started out my investment journey, I made an investment decision without knowing the difference between the three. Years later, once I discovered that there could have been thousands of dollars that went to me that actually went to somebody else, I felt very disappointed. This type of stuff really isn't taught in school for some reason. So I want to give you everything I know about it so that you can make better informed decisions before you make any investments, and in turn save you a lot of money and a bunch of fees. My channel has helpful advice on how you can make more money, save more, and of course, invest a ton more. So make sure hit that subscribe button so you can be notified every week when my new content drops. So let's get right into it. When it comes to investing, your goal is to maximize your returns, how much money you make. Let's say you do some research and you decide the best investment is to buy Enron Energy stock, and you go ahead and put all your money into it. Well, the first few years go well and you're making some money and you're happy. And then all of a sudden one morning, there's a report that comes out that shows that the vice president has mailed the chairman a letter alleging that billions of dollars in losses have been hidden through complicated balance sheets. As news gets out of this, people start unloading their shares by the boatload. People don't like the company anymore. The company isn't going to make any money going forward. Business is pretty much going to tank and it's going to hurt the company. Well, it's going to hurt your pocket as well, because if that's the only company you have invested in, your money is going to go down significantly. Now, you could have invested in multiple companies because that would have reduced the risk of how much money you would have lost. But that takes significant time and research to analyze each company to figure out when to buy them and when to sell them. Could you imagine sitting there hitting the buy button 100 to 200 times in one day? That's what these investment funds offer, a way to buy the whole jar of M&Ms in all different shapes, colors, sizes, and flavors in one easy purchase. Getting a good return on your own is incredibly difficult. In fact, studies show that a portfolio selected by a blindfolded monkey throwing darts at the wall could do just as well as a portfolio carefully selected by experts. Because stock picking is so extremely difficult and you want your money to grow and work for you and reduce the risk of losing money, investment funds like ETFs, mutual funds, and index funds were created so a bunch of investors could pool their money together and invest together. Investment funds have a couple different benefits. The first one to talk about is convenience. By investing in an investment fund, you get to own a bunch of stocks in one easy package. A mutual fund, for example, could have hundreds of different stocks, and you get to own all of those in one purchase. Owning a lot of stocks gives you diversification, which is the second major benefit of investment funds, which reduces your investment risk by spreading out your eggs. Instead of, like in the early example, putting all your money in one stock, which is the equivalent of putting all your eggs in one basket. Although both of these benefits apply to all three investment funds, ETFs, mutual funds, and index funds, there are key differences that if you don't understand them can cost you a lot of money over time. Let's first talk about mutual funds, as they were the first ones created. They're also known as actively managed funds. Here's an example, for instance. Say there's a mutual fund that has 5 stocks. Now, mutual funds usually have way more than that, but just for this case, let's say it has 5 stocks, and those companies are Nike, Verizon, Home Depot, AT&T, and of course, Disney. Because they're in a mutual fund, they're actively managed. What that means is they're controlled by a professional fund manager that actually gets to decide which companies stay in the fund. When you invest in a mutual fund, you can see now that you're leaving your money to an investment fund manager in hopes that he or she will pick the best stocks and get the best returns for you. It's all up to the fund manager and their decisions. If they do terrible, you're going to lose a bunch of money. Whereas if they do great, you're going to make some money. Let's say some time goes by and the fund manager decides to remove Nike from the fund. Now it's diversified differently and the manager can actually decide to add a different company. Let's say Target. Any stocks that these fund managers like, they're going to buy because their goal is to outperform the stock market and make you as much money as possible. When some really smart, well-educated professional is picking your stocks for you, this is called active management. When you invest your money into a mutual fund because they're doing all the work for you, it's going to cost you an arm and a leg. And believe me, I've made this mistake before and don't want to do it again. That's why I'm making this video, because it's going to cost you an average of 1.5% annually. You might be thinking, that's not that much money, Ace. What's the problem? Well, here's the problem. As your money grows and gets bigger and bigger over time, guess what? So does your fee, because it's not capped at any certain amount. It grows and grows as your balance does. Let's say, for example, you invest $10K into a mutual fund the first year. Well, in that first year, $150 is coming out of that fund and straight into the fund manager's pocket. However, when you start to grow that fund, let's say on year 4, you had $100,000 invested. That $150 is gone. Now they're taking, you guessed it, $1,500 for the same decision making they did when they took out $150. You see where I'm going now? And here's the worst part. If you start losing money, guess what? The stock fund manager's fee, $1,500, $15,000, whatever it is, it's still coming off the top. Depending on when you started investing in the fund, it's very possible that you could end up with less money than you started, whereas the fund manager is still getting paid thousands of dollars for their services. Here's a crazy fact for you. Research shows that 90% of actively traded funds actually underperform just putting your money in the stock market as a whole. In fact, Ray Dalio has been famously quoted by saying, trying to time the stock market is more difficult than competing in the Olympics. If you haven't figured out by now, mutual funds are just not cheap. That's why in 1975, the founder of Vanguard, a popular stock brokerage where you and I can buy and sell stocks, the founder of it, Jack Bogle, created a new approach. That, ladies and gentlemen, would be index fund investing. The broad idea of an index fund is, instead of having a fund manager that controls the investments and does all the work, you're using a computer which has certain criteria that it uses to pick stocks to buy and sell them at certain times, using what's called an algorithm, which, you guessed it, is cheaper to operate, making index funds a low-cost option. This means rather than paying an expensive fund manager to do all the work, a fund follows a particular formula that totally eliminates the need for an expensive fund manager to do the buying and selling. When you invest in an index fund, you're tracking a specific market and taking ownership in a particular index, hence the term index fund. What is an index, you ask? An index is just one simple way to just look up and see how the whole stock market did that day, or just a one sector of the stock market. A popular index is the S&P 500, which resembles the top 500 publicly traded companies on the U.S. stock exchanges. This typically refers to the overall performance of the U.S. economy. Each index has a provider, which is the company that creates the index based on certain criteria. For example, the S&P 500 has a provider that created it called the Standard & Poor's, hence S&P. Because the function of the Standard & Poor's is to manage the index, you're not going to be able to buy the S&P 500 within the Standard & Poor's company. In order to buy an index, you need to do so through a fund. That's where companies like Charles Schwab, Vanguard, and Fidelity come in play. Think of these companies as the middleman, where they're getting the info from the Standard & Poor's and providing it to you, the investor. You might be asking, Ace, how do I know what is an index fund when I'm looking at the brokerage website? When it comes to buying an index fund, it typically has the name index fund in the actual name. For example, if you're looking through Schwab's list of possible funds for you to purchase, just look for example, Schwab S&P 500 Index Fund. The cost of these funds comes down to the expense ratio. For the Fidelity 500, which tracks the S&P 500 index, the expense ratio is listed at 0.15%. What that means is for every 100,000 you have invested, it's only going to cost you $150. But if it was an active mutual fund that's actively managed, it would cost you $1,500. Big difference. Do not make the same mistake I did when I started out on my financial journey. Because of these fees, I do not like mutual funds. These fees will slowly eat into your good investment returns. By investing in mutual funds, you're paying fees that aren't quite justified. You can get similar results investing in index funds or ETFs, which we're going to get into shortly. It's important to understand an index fund is actually a category of mutual funds. So when you go to buy an index fund, don't be confused when you see it listed as such. The whole benefit of index funds is that it will presumably outperform actively managed funds over a long period of time. So Ace, we get it. Index funds are much cheaper than actively managed funds, and they perform similarly. What about ETFs? What's the difference? Actively managed funds, which are mutual funds, and passively managed funds, which are index funds, are both mutual funds at the end of the day. They're just different types. What's the significance? They both can only be traded once per day. ETFs stands for exchange traded funds, which are very similar to index funds, and that with one easy purchase, you're investing in a basket of stocks. But the special thing is you can buy or sell the fund throughout the day, unlike mutual funds. So they act in that regard more like a regular stock. A lot of times you'll hear the terms ETFs and index funds interchangeably, but they're not the same thing. And that's why you're watching this video, because you want to know the real thing. ETFs have real-time fluctuations, whereas index funds and mutual funds are only updated with the price once per day. There are some similarities between ETFs and index funds, and that would be the cost. For example, the expense ratio on Vanguard's S&P 500 ETF, aka VOO, is only 0.03. Peanuts. And when you're looking at the index fund from Vanguard for the S&P 500, it's a similar cost, coming in at only 0.04%. Wrapping things up here, a mutual fund is an actively managed fund controlled by a person, what's called a fund manager, who actively decides which investments should or shouldn't be in the fund. An index fund, however, is a passively managed fund, although still a type of mutual fund. Instead of being controlled by a human, it's operated by a computer. It's controlled by an algorithm that tracks companies that resemble a particular market at a much lower cost. The main difference with the ETF is that ETFs can be traded at any time during the trading hours, kind of like stock. Mutual funds are great because instead of investing in one stock or investing in multiple stocks and hitting that buy button 200 times a day, you get to hit that buy button one time and be in control of and ownership of 200, 300, sometimes 400 securities at one easy purchase. Why was the index fund created then? Well, in 1975, a man named Jack Bogle saw the opportunity to offer people lower cost options when it comes to investing in a pool of companies through the use of computers versus using an expert human being. Some people didn't like the fact that you can only trade index funds once per day, hence the creation of the ETF. So Ace, I get it. You gave me the facts. You gave me the details of all three options, but which one is better for me? ETFs, mutual funds, or index funds? Well, it depends. It depends on if you need the ability to trade the fund multiple times throughout the day, which an ETF can provide for you. Or do you need the automatic investing that an index fund can provide for you? Or do you just prefer a trusted human being to be in control of your investments that a regular mutual fund provides? Because of the fact that ETFs trade like a stock and you can watch it on a stock chart go up and go down, depending on the personality of the person, it can oftentimes push you to do impulsive buying and selling. Human nature has a tendency towards gambling-like behavior. Sometimes we're simply chasing after things that are moving up and selling things as they're moving down, which sometimes is the opposite of what we should actually be doing for the highest return. What many people that get into investing don't know is that although you can have all the details, the past performances, at the end of the day, stock market investing has a lot to do with psychology. Similar to on Black Friday, when you turn on the news and you see 35 people trampling over themselves to save $100 on a big screen TV, in the similar fashion, the stock market has the same tendency to get people tripping over each other to buy that stock, which oftentimes produces a price that's overinflated, so that when you finally get to purchase that stock, thinking that you got a good deal because everyone's buying it, when in fact you bought it at the time when the people in the beginning are starting to sell. Don't worry, I'll make an entire video on the psychology of trading that I'm sure you guys will enjoy. For me, I'd rather have the ability to trade multiple times a day, but that's just me personally. For someone who's just starting out, that may not be such a good idea based on the details that I gave you earlier. Comment below on your thoughts on any of the three options. I'm curious to know about your experiences with any of them. Either way, index funds and ETFs are both solid approaches, as both of them will save you a ton of money versus mutual funds. There's just a lot of misconceptions out there when it comes to investing in ETFs, mutual funds, index funds, especially when it comes to people that are young of age. Whatever you guys decide to do, I highly recommend you start today, because the longer you wait, the less compound interest is going to be able to help you out. I hope you all enjoyed this video and can now distinguish between the three types of funds. If I earned that like, You know what to do. And if you guys are new here, go ahead and subscribe so you can see my latest content dropping every week. If you want to know how to get very rich off of investing in just 3 ETFs, check out this video. Remember, ladies and gentlemen, it's not about what happened yesterday. It's not about what might happen tomorrow. It's about what you do right now. So we'll see you at the top because the bottom gets too crowded.